Welcome, everyone. We're happy to have you here for Crush Your Exit, Ready Your Finances for IPO or Acquisition. There's a lot of talk about whether the IPO window is opening or whether companies are going to continue to stay on the sidelines. So we brought together a panel to share their thoughts and to help you prepare for any scenario. So with that, let me introduce you to our panelists. Tracy Knox is a board member at Getty Images and a seasoned CFO who led two publicly traded companies to exit, RightSide and Drugstore.com, and who led Rover Group's public process via a SPAC merger. Fien is the current CFO of TextNow, who led Chef Software through a successful acquisition and scored multiple rounds of funding for Impinj before leading it through an IPO. Vanderlaan is a partner in Orrick's Capital Markets Group who provides legal counsel for IPOs, follow-on offerings, M&As, and much more. Jack Gaziano is a commercial banker for Silicon Valley Bank, here to provide his perspective on the markets. And finally, myself, Ann Lucchesi. I act as a liaison between the tech banking and private bank. I'm a certified financial planner, a certified equity professional, and I advise founders and executives of private and public companies on how to plan across their entire balance sheet. All right, let's kick everything off with a poll question. So in 2021, there were 1,035 IPOs. So far in 2024, there have been 72 US IPOs, according to Stock Analysis. How many IPOs in total will 2024 produce? Less than 150? Between 150 and 300, greater than 300. The question should be popped up on your screen for you to answer. And while you're doing that, I'm going to go over the topics we're going to cover today. All right, we're going to start off with some industry insights. We'll then go into a deep dive with our CFOs. We'll finish off with a legal perspective on IPO and acquisition readiness. And finally, we'll have Q&As from your peers. We've woven a number of the answers to the questions we received in advance throughout the presentation. If you have any questions, please submit them via the Q&A section and include your email so we can follow up afterwards if we don't get to them during the session. And let me remind everyone, this presentation is for educational purposes. Each situation is unique. Please consult your own tax and legal counsel. All right, let's take a look at the results from the poll and see what everyone thought. So it looks like a majority of you, over 50%, think we're going to be between 150 and 300 by the end of the year. Of course, we won't know the answer until the end of 2024, but it's great to see what everybody out there is thinking. Let me turn it over to Jack to share some industry insights. Jack?
Thank you, Ann, for that introduction. My name is Jack Gaziano, and I head up our corporate banking practice at SVB, where we assist and advise our most scaled companies, both public and private, with capital markets issues. I want to spend a few minutes talking about the current environment and where we are in the market cycle for IPO and M&A transactions, as well as share with you some of our recent observations. We all know that there's a sizable backlog of companies that are waiting for the IPO window to open, a speculation that is fueled by a strong stock market and the anticipation of rate cuts. For the purposes of our discussion today, when I refer to an IPO or initial public offering, I'm also lumping in alternative forms of taking a company public by means of SPACs or direct listings. As you can see from the chart on the left, IPO activity in recent history peaked about 3 years ago and has been pretty stagnant over the last 2 years in particular, which is why we have such a glut of companies who are wanting to go public. Presently, there are about 725 active US unicorns of various vintages waiting to go public. About half of these companies are in software, including AI and machine learning. Then the next largest categories are in healthcare, commercial products and services, consumer retail, and finance and insurance. About 50% of the unicorns since 2010 have exited via an IPO. So if that would remain consistent, then about 350 unicorns will be looking to go public once that window opens. It's also noted that about 20% of these companies will need to raise a round in the next 12 months to avoid running out of runway, putting even more pressure on the need for a liquidity event. Now, a little about M&A activity. Oftentimes, whether initially as a stated intention or not, companies often find themselves dual tracking to go public and/or considering a buyout. We hear a lot about all of the capital on the sidelines, particularly with the proliferation of multi-billion-dollar mega funds, in addition to the large serial acquirers with substantial war chests. And much of this money is deployed in the form of buyouts. As a side note, with all of the private equity firms trying to put money to work, increasingly, we have seen more large take-private transactions in the public companies within our own portfolio. Interestingly, the M&A market activity, which also peaked a few years ago, has slowed down somewhat, despite the vast amount of dry powder on the sidelines, mostly as a result of the inability of buyers and sellers to agree on a sales price. Many companies have taken cost-cutting measures over the last couple of years in an effort to preserve cash and extend runway, but in the end, some companies might be forced to sell if they cannot raise additional funds. There's also a trend where fewer companies are disclosing their valuations upon exit because they are substantially lower. Of note from this slide, AI companies seem to be the most desired vertical for M&A activity, followed by fintech, health tech, big data, and e-commerce, which is somewhat similar to the concentrations for the US unicorns waiting for the IPO window to open. It is noted that one of the 4 funds that closed in 2023 also focused on AI, or had a particular focus on AI, and many of the companies that they're investing in are focused on the applications of AI as opposed to the development of core technology. Whether you end up going public or selling your company, the transaction could likely be transformative both professionally and personally for you and your employees. We know as finance professionals, everyone comes to you with questions about what you can do in preparation for this potentially life-changing event. So hopefully our program today can arm you with some answers and strategies. Now I'll turn it back to Ann.
Great. Thank you so much, Jack. That was a terrific backdrop for our guests to come up. We're going to bring up Tracy and Evan to talk through a CFO's perspective on all of these things. So I would love to start off with each of you doing a 30-second intro of yourselves to help set the context. Tracy, maybe you could start us off.
Sure. So you gave me a great intro, but a little more color. 25 years in finance and technology. I've been the CFO of 3 public companies, 2 of which I took public. In addition to Rover's SPAC merger, I took Right Side public via direct listing back in 2014. In terms of experience with M&A, I've sold 2 complete companies, but also have acquired and sold multiple subsidiaries and companies within each of those over the years. And I retired as a CFO back in 2022, and I've now transitioned to advisory work and serving on boards. In addition to the Getty board, so that's the public company board I'm on. I'm also on a private company board, which is Babylist, and a not-for-profit, which is Pet Partners.
Great, thank you. I feel like you cover a little bit of everything. Evan, how about you? Can you give us a little bit of your background?
Yeah. Well, one, thanks for inviting me and to participate in this. You know, I know you got choices and you chose me. So I just wanted to thank you for including me. And I've also, got more gray hair than I'd like to admit. So I've been a CFO for 24 years. I'm in Seattle. Right now, I'm the CFO of TextNow. TextNow is a company that makes cell phone service free. So we're like the Hulu or Spotify of cell phone service. You could cut the cord and get our service for free. I sold the company, as you said, that was an enterprise open source software company, Chef Software, and I was at Impinj for 18 years, quite a long journey, many rounds of private financing, an IPO and a follow-on, and I stayed on as a public company CFO for 2 years. And then Tracy and I are both in the Seattle area, so kind of active in the Seattle CFO community. Last point, I've been a SVB client for 24 years, as a corporate banking client for all 24, and then the last 8 or so as a private banking client. So I'm very proud and loyal to SVB.
Wow. Thank you. I feel like it was a commercial. I appreciate that, Evan. All right, let's get the conversation started with some surprises that you guys encountered in going through the public offering process. Tracy, what are the top couple of things that you found most helpful when you went through the IPO process?
Sure. Well, I think the most important to me is realizing that an IPO or a go public process, if it's SPAC or direct listing, that is a transition point, not a destination. Like the hard work actually starts when you get on the other side of that major transaction, and life changes pretty significantly. So I think just really being honest with yourself, that's what's going to happen, was most important. The other one was to leverage friends. You know, the first thing I did was call Evan up and say, hey, will you have lunch with me? And I picked his brain on what happened when he went public and how he prepared for that. And then I also think surrounding yourself with a strong team, again, leverage your friends, make sure you have a strong number 1 and number 2, because it is a tremendously burdensome process. And then finally, on a personal note, at home, you know, I found it helpful to outsource everything that I could, so that I was able to leverage my time well.
Great. Well, thank you. And Evan, maybe anything you'd add to that, or anything maybe that was a surprise or you wish you'd known when you were going through the process?
Yeah, I had so many surprises. One is like the role of the stock price and being a public company. And I remember like thinking we were like Amazon when we went public, and we were building this long-term company, and the daily stock price, and doesn't matter because we're so focused on this long-term thing. That was the attitude I thought you could own. But you can't own that attitude, because you've got investors, you've got employees, you've got shareholders who want liquidity now to meet whatever needs they're going through. And it's not fair to them to just like be inattentive to the stock price and just worry about the long term. And I didn't appreciate, you know, like the short term real time needs of our shareholders. So that's one big learning. And then I'll just give you some inside baseball on things like we're getting to the nitty gritty already here. But one thing that surprised me quite a bit, at the end of the IPO process, you will have finished this roadshow. I did kind of the traditional roadshow. I don't even know if you have roadshows now, but you get on a plane and you go see a bunch of people, and you build this book of demand, and then you're going to allocate your shares. And you're deciding who do you want your shareholders to be. And your banking syndicate is very opinionated on what it should be. And they want it to look like this and this and that and that, because they want to reward their clients. But you don't share those objectives, and you have it. And so you actually get into this big wrestling match on allocation at the end. And I was ready to pop a cork and have a party. And yet we spent the whole night after our investor meetings, when we knew we had a successful IPO, focused on allocation. And nobody whispered that into my ear before going public.
Yeah, I think that's a great point, right? It's a process, right? You don't get to that destination and pop the cork. Challenging. So along those same lines, Tracy, I have often heard it said that one of the most important things you can do to have a successful IPO is to tell a compelling story. So how did you prepare for that piece? And then on top of it, that grueling roadshow that Evan alluded to.
Well, it definitely was grueling. And, you know, I think the biggest thing for a public company CFO is to be a good storyteller. But even well before that, when you're doing your seed round, when you're doing your Series A, and you're constantly telling a story, I will say that once you get bankers involved and attorneys, that story changes, because everyone, like Evan said, everyone has their opinion on how you should tell that story. But ultimately, you need to make sure you're comfortable with being a storyteller, because you are going to tell it so many times. And really, I thought what was most important during that process was being good at answering hard Q&A on the fly. Right? It's one thing to learn the story in the presentation and to go through it multiple times, but it's how you pivot and respond in the moment and build trust with investors as they're throwing questions at you that I think is one of the hardest skills to learn.
Yeah, that's there's nobody there to really prepare you for that piece of it, I don't think. And then another thing that I've heard come up a lot, Evan, is this process of getting D&O insurance as you go public, like something that you've probably never thought about, or maybe you have a little bit before, but it's something really important as you go through the process. Tell me a little bit about your perspective on this.
Yeah, I do want to add on that, but I thought Tracy hit on some great points with the last question, which is I learned so much. I became a much better CFO by preparing for earnings calls, preparing for roadshows, because you think you know your business, but we're kind of living in it in the day to day. And so the being able to abstract it and tell a story and then communicate what's going on in the business to other people, it makes you much better CFO. It makes you much more successful at your own job. And I didn't know that was going to happen, but I started to embrace, earnings calls and kind of investor meetings because I knew I would be better. And on your question on the D&O, boy, so that was another surprise for me. As private companies that are tightly held, we have relatively low D&O costs because we're not really going to sue each other. But then when you go public, all of that changes. So two things are true. One, the probabilities of you being sued as a new public company are very high. And in fact, I was sued. All the directors and officers of Impinj were sued. And so because that is so true, the premiums of getting D&O are really, really, and they're so complex. I'm not going to talk about it now, but there's A side, B side, C side. You have to spend an afternoon understanding this stuff to make sure there's experts that'll help you, but it's complex. It's really expensive. So you go on a roadshow to insurance providers and you tell them what's so great about your company so you can drive the fees down of the D&O premiums. And I didn't know I was going to be going on a roadshow, to D&O investors, but you do that, it's still super expensive and you'll probably still get sued. Oh yeah, and then final thing, if you do get sued, it almost always are settled for the amount of D&O insurance that you buy. Because the company doesn't want to give up any of their money. The investors know that, or sorry, the litigants know that. So they're going to take the easy money. So anyway, that's it's a problem with our litigation system and all that. But anyway, don't be surprised, and it's laborious.
Yeah, and I think I'm sure that Albert will have a viewpoint when we get to him later on. But I mean, I always found in the investment banking world, there were people that were professionals at figuring out when to sue companies. And so it's an inevitability, not something you're going to avoid. All right, so let's move over, Tracy, and talk a little bit about the idea of culture, because most of the time in startup world, culture is pretty important. And it's actually, I think, a little bit difficult to retain that as you go through the IPO process. What did you do with your management team? What did you and your management team do to kind of keep culture intact as you did that?
Well, I think I was lucky at Rover. We had a very strong mission and vision and values oriented. It was a values focused and oriented company. And so we lived and breathed our values. And so for me, that would be number one, is make sure you have very clear values, because everything you do after that is you're going to refer back to those values and reinforce them. The two biggest pain points that we had at all three companies was transparency. A lot of smaller companies, as they lead into an IPO, have a big adjustment on locking down systems and not being as transparent. And the other is adding on controls and process. Right, you have to do that because Sarbanes-Oxley, and well, it's just good prudent business as well. Your investors will thank you for that. But those were the two biggest changes for us. But it's always a choice. On transparency, for example, you could decide you want to be transparent, but then your trading window is very tight. It's very small, and you have to have pre-clearance for more people. But it's a choice you can make, and you can operate your company that way. The other one is on controls. That is a choice as well, because you can identify a large number of controls, which is going to make your life difficult, or you can try and streamline the controls process so that it has minimal disruption to the operations of the business. So those were the two biggest things that I found.
Thank you. Yeah, I think that that's the thing, is a lot of these small private companies, I wouldn't say small, some of them are pretty big, but you go in and it's open door policy. Evan, anything to add on there before we shift direction a little bit?
Yeah, we used to, in the early days of going public, in the first year, we would have, weekly meetings. And I'd say to our employee base all the time, don't forget this, like Warren Buffett has this famous quote. He's like, your stock price on a daily basis, your stock price is a voting machine, meaning it's like about popularity. But on the long term, it's a weighing machine. And ultimately, the value of the company, like investors will long term figure out the value of the company, so you don't have to worry about these daily variations. And the reason I said that is because our stock was volatile, out of our control. One morning in a year after being public, I woke up and Amazon had bought Whole Foods, and our stock price, and we're not nothing to do with either of those companies, but we just digitize stuff. We can make an item have a digital life. So our stock price jumped 22% on this news, and I could not figure it out. And so I had to go into that meeting and tamper down, the excitement. And on the reverse, our stock price got to $11, and I had to remind folks it was a voting machine too. So it's easy to, like, you can do all the reminding you want. People still have their liquidity needs. It is definitely one of the volatility in the stock price is definitely one of the challenges of being public.
Yeah, no doubt about it. So I'm thinking maybe now we're going to shift towards the idea of the M&A process, of which both of you have had great experience with. Evan, maybe we'll start with you. What did you find most difficult in going through the sale process, and what required the most preparation?
Yeah. So I sold Chef Software to a strategic acquirer in 2020. And that was the first time I had sold a whole company. Like Tracy, I have sold divisions, but not a company. So my experience to now on diligence had been about investment rounds and then the IPO process. So I thought I knew kind of how to prepare for diligence and how deep investors go. Well, I was not prepared for when you get acquired, 100% of you gets acquired. And it makes sense. Like the investor who's going to buy the whole company is making a much bigger bet than any bank as a part of a syndicate, an investor in an IPO, or even a VC investor. So the things that they take the time to become expert on, one, I had to get a lot smarter too, but I was just really impressed with the diligence that they do, how deep they'll go. It's very different than the other two. And that was very surprising to me. Now, the other thing is, having a good banker prepares you like really well. A good banker will ask you all those questions first and have you be prepared before you go to market. So you're not responding to like surprising questions, but they pretend like they're the investor and they're like, oh, why does your model say this, but your management presentation say that? Those don't make any sense. So that's the role of a good banker, to prepare you for this diligence process.
Yeah. And anything there that you would add, Tracy, in your experiences in going through that?
Definitely, the bankers will pressure test you. But what I found surprising, or maybe it shouldn't have been surprising, is how deep they go into like your cohorts, your customer cohorts, and really looking at quality of earnings. And sometimes they'll get a QFR or QD report done. So they deep dive into just basically the quality of those earnings, not just the earnings. The other thing that I found is that like when we sold drugstore to Walgreens, when they came in to do diligence, it wasn't just about diligence, it was about integration after the fact, because they are making sure that they know exactly how they're going to integrate the properties. So it's not even just about validating the value, it's about figuring out what the go-forward plan looks like, especially if you get acquired by a public company.
Yeah, a lot of variation there, right? Depending on who the acquirer is. Tracy, one of the things that has come up as a question from a lot of people on here was this idea that, hey, founders spend time growing their business, not developing this network of buyers. So do you have any advice for them on some strategies for finding a buyer? And how should they evaluate a banker in this process? Because you've talked about how important that banker is, but not so easy to figure out how to pick one.
Yeah, and I'm sure I've had many missteps along the way in this. But I've been either lucky or not that many times the buyer comes to us. Like it just comes out of the blue. Someone makes an acquisition overture, and that starts a process that you have to go through, especially as a public company. You have to follow up on that. Now, if it's a deliberate outbound attempt, so at Right Side, we had two sides of our business. We ended up wanting to sell the wholesale side of the business very deliberately. So we did go out and hire a banker. And I will say that it all came down to who did we trust the most? Who did we trust on advice? Like that was critical for me because a lot of bankers are maybe not, don't have your best intentions at heart. They just want to get a deal done. And then when they pitch you, for me, I was looking for what type of acquirers did they put into their pitch deck? Was it a wide net, or were they just like throwing out the obvious things? And then did they have relationships with the key ones? Because if they have good relationships without violating independence, it's helpful if they already know and are friendly, though, with a lot of the potential acquirers. For me, especially on the SPAC merger, it was who did they propose in their deck for the underlying team, right? You have the managing director comes out and pitches the deal. They're not going to be working on the deal. You're going to be working with a number of different people. And so for me, did I get the A team or did I get the junior team? And I actually switched bankers from someone they thought they were going to get the deal. They pitched us a junior team and ended up switching from Goldman Sachs to Morgan Stanley. Now, I will say I then switched back to Goldman Sachs for the secondary, but it was, I don't think you should have allegiance just because you have relationships, and don't be afraid to switch.
Yeah, great advice. Evan, I'm going to have you add on to that, and then maybe also some tips around running an efficient process as you're going through that.
Yeah, well, the way I thought about my bankers for the IPO and a sale process was a little different, which is for an IPO, you're going to have a syndicate of banks. And so I was less concerned about having a gold-plated name like be lead left, because there's going to be a syndicate there. It's a strong foundation. You can rely on other people. And then I remember on the roadshow, on the IPO roadshow, when I would have private moments with investors asking them, are they more respectful if a company is lead left as Goldman as opposed to a lesser known bank? And they really don't. They said they don't pay attention to that at all. On an M&A, I do feel a little differently. Like I am looking for reputable banks that are respected in the industry. I mean, they're all respected, I guess, but I want the gold-plated. I'm down selecting to a list of top tier banks. Definitely, like Tracy says, I'm choosing on the relationship with, do I feel like I can trust them and they have good advice? Super important. You just ultimately have to feel comfortable with them. Like you would want to go to dinner with them, if you had a free night like that. Hopefully that's the answer to that question. And then what's new, what I really learned about good M&A processes versus bad ones is when your banker is driving a process that the buyers have to react to. So they believe they're one of many, even if there's only a few, one or two or three parties. There's got a process means like there's published deadlines, and they can say with confidence to the universe of potential buyers where everybody needs to submit their IOI by 2 weeks from today, and that's the deadline. And so then you're in charge when they're reacting to your timeline, whether you have a lot of interest or not. You have to let the bankers run the process, take command, and that changes the dynamics into the company's favor because you hint towards more competition.
Yeah, that's absolutely true, and something probably you don't think about in front of that. I'm going to switch over to the idea of, I always think two parts on the cap table. It's cap table cleanup going into an IPO, but it's also that in an M&A process, a lot of people don't understand equity compensation gets treated differently than your equity does. And so I was wondering, Tracy, did that come up? How did you think about that problem? Because I've seen a couple situations that were not very pleasant because it wasn't well thought out in front of it.
Well, I could take this from any number of different perspectives. For the CFOs out there, really, I focused on change of control triggers in the agreements, not just the executive agreements, but the base equity plans as well. And so I'm going to take it this route for a second. We can talk about equity compensation, what happens when you have to re-up and you vest in new shares as well. So change of control triggers, how much is going to accelerate? It's not, hopefully isn't 100% unless it's a high level executive role. And then the tax implications of all of that, because when it accelerates and pays out, it's standard Knox. And now, for good or bad in the state of Washington, for example, there's a new capital gains tax on true vested equity. And so you get hit by that as well. If it's long-term capital gains. So now you've exercised your options early so that you get long-term capital gains tax. And in Washington, you get kind of hit across the head when you end up selling that. So there's a ton of tax implications. And then when you're being acquired, a lot of times the acquirer, one, will not want to say you're triggered on a change of control. So what types of triggers do you have in there? How do you detail it out? I've seen where CFOs are triggered or not triggered in various cases just based on the wording. And then if you are staying, a lot of times they want to roll your equity forward into, especially with private equity, into the new company. And there's different ways of compensating you going forward. So there's no one size fits all, in my opinion, but those are some of the things that as a CFO, I want to know exactly what I'm going to get and what in that situation or be subject to, and what the executive team is going to do, especially if I'm going to stay, because I want to make sure the entire executive team is also incented to stay and continue operating the company.
Yeah, absolutely. All right. I want to move the conversation a little bit more to the personal side of things, because I think it's super important for people to plan well in advance of a liquidity event. So Evan, would love to start with you if I could. How did you kind of think about preparing your executive team and your employee population for that IPO process? And then also what it's like to be in a public company, which is different.
Yeah. So when Impinj went public, kind of SVB was building their practice for kind of executives with private equity and private company equity. And I immediately embraced that and introduced this kind of the services that your team could provide to all of our executive team. And the reason I did that, like, why did I lean in so much? Because SVB was willing to offer me a level of service and products that other banks wouldn't offer me, because we were still a private company. I had illiquid private company stock, and it was like 99% of my wealth was based on that. So no other banks would really allow me to access that and do the right things for my family. But SVB, would do that. And it made a huge difference, for me. So I really appreciated that. And then access to the private bank and things like that. So I knew when I realized it was a good offering for me, I definitely encouraged our executives to do it. And many of them became SVB clients, but not all of them do. And that's fine. That's up to them. And then for employees, we had a lot of education sessions. Both SVB helped and our law firm helped us prepare employees for what's going to change, like the trading windows that open and close, when you can do what you want, how we're going to change how much information we share. So we did a lot of education prior to going, I guess just after maybe prior to going public, because you don't always know exactly when you're going to go public. So prior and then immediately after, I guess there's that 6-month lockup period. So we had some time to talk to employees about that. So those were the two methods we used.
Well, I want to continue this conversation because it's so great. So thank you both for this. It's been terrific, but I think we need to move on. We're going to come back to both of you for Q&A. Before we move on, we're going to start up with another poll question. And so let's see if we can get that up on the screen. We are going to talk about M&A here. So what is the top reason for failed M&A transactions? Is it due diligence, accurate valuation, a lack of strategic alignment, or flawed integration planning? And so that should be up on your screen for you to answer. Next up, we're going to be hearing from Albert on some key legal considerations for acquisitions and IPOs. Before I turn it over to him, let's take a look at the poll results and see what all of you have said. All right, it says most of you think it's on the flawed integration planning. In fact, according to Astor Walker and Company, they say it is a lack of strategic alignment that causes M&A transactions to fail. I found this pretty interesting. Hope you did too. All right, so now let's hand it over to Albert to take us home with some legal vision on M&A and IPOs. Albert?
Thank you, Anne. Really appreciate it. And I'm really happy to be here as well. And I think there were just a ton of fantastic insights that Evan and Tracy just set forth in their conversation. And I'm going to use that as a jumping off point. One of the things that you heard them refer to multiple times is diligence. And there are certainly different types of diligence that you're going to do for an IPO or an M&A. Regardless of what that looks like, the advice that I always give to clients is prepare early. You don't have to, have a data room the day you start your company, but when you do your first data room for a fundraising, like a Series A financing, for example, you should really consider that as the jumping off point to keeping a data room up and running. You're going to be doing due diligence for every transaction going forward. There's no reason you shouldn't just keep a data room up and running. That has a huge impact on when you get to an IPO and then when you get to an M&A event. The IPO, you're going to be doing very heavy due diligence. It is a different type of due diligence than you're going to be seeing when you get to an M&A event. Which is that more, in the weeds and understanding the business for that integration perspective, as they were referring to. But in an IPO scenario, you're going to be doing underwriting due diligence, which really is underwriting due diligence defense, so that the underwriters can basically go into court if there's an issue with the IPO and say they did this due diligence in order to avoid litigation, which we'll also talk about here in a couple minutes, because that's a huge part of why we do a lot of the things that we do in preparation for an IPO or an M&A exit. But as a baseline, just keeping that good corporate hygiene and getting your house in order in advance of an IPO or an M&A event is absolutely critical. You're going to have 1,000 other things going on, especially at the executive team. For example, a roadshow that's going to take up an undue amount of time for folks isn't going to be something where they want to be also focusing on why did we not have our documents in order from our Series A financing. So the more you can do in advance with that type of diligence activity as you go through the life cycle of the company, the better. So my main point there is start early and be very consistent through your financings on keeping a data room open. Don't close it, keep it up and running, keep those activities as you would normally. The second big thing that I really want to hit on here, and I think is really critical for either of these exit strategies, whether it's an IPO or an M&A event, is really understanding and being able to describe your business, not just to the investor community. And I think understanding and knowing how to tell that story is uber critical, as Tracy and Evan so greatly articulated during their conversation. But there's also a matter of how you tell the company story internally. One of the things that Evan hit on was really that culture shift that you have when you're going through an IPO, for example. That culture shift for many startups is a huge change. There's usually extreme amounts of transparency that employees have about the business. At least they have access to it, even if they don't use that access. I think folks are surprised at how many employees actually do look at other metrics in the business that are outside of their groups. And once you start to clamp down on that for a very good reason, which is you don't want them to have access to that information to help themselves from being able to use 10b5-1 plans and those things, which I'll talk about in a moment. But really what you want to do is make sure you're telling the company story in terms of what the next steps and the next phase of that company are. So learning how to make that culture shift, but not in a way that's really going to be and negatively impact the company, is absolutely critical, especially during an IPO. The same thing with an M&A event. That has some different aspects to it, depending on whether it's an M&A event where it's anticipated that the company will continue as it go forward, kind of sub-entity, or it's really going to be fully integrated with that entity. But you still need to understand how, as an executive team, to articulate and mention that to your employees in a way that's not going to completely blow up something where you very much need their input during the course of that activity. So circling back to some of those other points around 10b5-1 plans and that critical element where a lot of people are really looking to ultimately get a liquidity event from an employee base all the way up to the executives. It's absolutely critical as part of any IPO to really start early education with your executives in the first instance And then at the appropriate time, making sure your employees understand certain of the policies and the regulations that they're going to be subject to after an IPO. In particular, there's an insider trading policy that all employees will be subject to. That includes blackout windows, that includes trading restrictions if you come into contact with material non-public information, things of that nature. I think I have the most surprise of anything during the initial phases when we talked about an IPO with executives, with how limited their actual ability to trade is during the initial months after an IPO. Everybody knows there's an initial lockup, but then after that, I think a lot of people are like, oh, and then I can freely trade my stock and be, monetizing all of this position I've had since I was a founder. That's really not the case. There's a few different aspects of that. Some is the pure legal and regulatory, but then there's also another overlay of investor expectations. A lot of the investors that you're going to be talking to on a roadshow will often say, what are your plans? You have a very large stake in this company. We don't want you to be selling immediately after this IPO or really within the first couple of years. We want to show that you are still dedicated to this business. And some, I think, founders find that to be a little bit not a great look for the investors, but at the same time, they want to know that they're not going to be selling out. They're not going to be buying into a company where the founders are going to be selling out and immediately liquidating into that. What does that really mean for folks? That means planning is critical. Again, making sure you understand the timing when you will be able to get into the market and utilize things like 10b5-1 plans where you have to enter into them without any MNPI. So it's got to be after a quarter end. It's got to be when you don't have a potential acquisition on your books, things like that. So ultimately, you really want to be in that planning phase very early on in the public life cycle. And that's something I think that's not well done in many initial phases for that planning, and it sometimes does sneak up on people. The one thing I do want to hit on is actually another really the beginning of the whole conversation. The thing that I try to do as counsel to companies who are engaging in a public process is minimize those surprises. I think that it happens in almost every scenario where there are a few surprises along the way. But as outside legal counsel, the one thing that we try to do is really minimize those surprises across the board, whether it's from just a due diligence or a deal perspective. What does it really mean to be a public company? We try to get that information into executives' minds much earlier in the process than we otherwise may. It sometimes is overwhelming and people glance over it, but the worst thing that we want to hear on our end is, oh my God, I'm surprised that this is happening now. Like, that is what we try to minimize and try to do. It is, however, a very intensive process, and I think people get surprised even though they've heard it 5 times and you've not been focusing on it in the past 18 months. But what we try to do is ensure that the surprises are at least minimized from that perspective. And that goes to the point that you see here in the little considerations we have in the background here. Picking advisors. Legal counsel, obviously, I won't go into that, but at a general matter, you want to make sure you're picking advisors who you trust and you work with and that have gone through these processes in a manner that you really are going to be working with them side by side and understand that. On the banking side, I think I will leave the commentary that Tracy and Evan had, but you have to make sure you understand what you're getting with the various bankers you're engaging on both an IPO and an M&A event. They're going to be critical to whatever those processes you're undertaking ultimately are. And the amount of trust that you are putting, especially in the M&A context, into that banker to find the right home for the company in those situations is extraordinary. And so you really have to know that they're a trusted advisor, and why, for instance, Evan went the direction that he did, finding that echelon of folks that really can be trusted in that kind of a context. From the IPO perspective, I think making sure you sit down and have bankers that have analysts internally that they can be talking to, not just on the ECM side, but also on that analyst side, is also really critical. Another great way to make sure you're getting with the right bankers is talking to your investors separately around what they think the banks and the analysts that they respect and trust in the space really are looking to as well. So that's another way to just ensure you're getting a good look from just an outside perspective as to what those banks and bankers are really looking at. But ultimately, making sure that you can work with these folks, especially on endless days during roadshows. And Evan, by the way, they still do roadshows. It sometimes is even crazier now because you have Zoom, so you can do back to back to back to back to back. And then you get on a plane and you do back to back to back to back, and then you get on a plane again. So it's still the same thing, even more accelerated. The pandemic certainly helped with that aspect of it. And then look, the other thing that I want to hit on here too is almost every transaction I think that we're doing these days that ends up in either an IPO or an M&A context starts out as a dual path. Most board of directors want to make sure that the valuation that they're seeking in an IPO is going to be reflective of the best value they can get for the stockholders at the company at the time that they're engaging in that transaction. So they want to at least do some sort of an M&A market check to at least understand what that process looks like. Now, that may go away very quickly because an IPO is really the right path for that company. But in most cases, all of the companies that we're representing do at least some sort of a gut check from an initial dual path perspective. That puts a little bit of, I think, additional focus on those advisors that you're hiring at the beginning and making sure they can handle those types of processes from that dual path perspective, but also something that you just want to keep in mind as you're going through and making sure that those avenues are available. Again, diligence is going to look the same for many of those, but you want to just be aware that you're going to likely be asked in many of these situations to dual process from the outset. So with that, I think, Anne, I'll turn it back over to you and we can go from there.
Thank you so much, Albert. That was really wonderful. I appreciate all of that backdrop and wish we had a lot more time to cover more things. All right, everyone, you will be receiving the recording and slides over the next couple of days and an FAQ over the next month or so. Please send this on to anyone you feel would benefit from it. For those of you planning an exit, we can help with personal planning workshops for your executive and employee teams. Orrick is also happy to lean in on these types of educational programs. We find them helpful as people are going through that process. Now, what I would really like to do is move us on to Q&A and throw out some questions that have come up along the way, both that were introduced beforehand and that have been thrown into our Q&A session. I want to start off really with asking Jack a question, which is, as we begin to enter a more active M&A environment, which all of us are expecting, what do you think the impact of higher interest rates will be?
So unfortunately, interest rates is something that affects all M&A activity. And I think back to, just a few years ago when the cost of capital was very cheap, both in debt and in equity. And now it's, relatively speaking, higher. However, companies will continue to acquire and be acquired. So I think it's something that at the end of the day, you obviously as finance professionals need to factor it in. But relatively speaking, from where we are right now, interest rates are expected to go down marginally. I also read something recently where they might even go up a little bit, but it's still mostly sub 10% money. And if that isn't something that can be you figured out, or if you're making an investment, any kind of an investment, you just need to be able to get that in your return.
Great. Well, thank you. Yeah, and I know that, it is a shifting environment for all of us, which we haven't been in for a while, where it could go up, could go down, presents some interesting challenges. So Albert, I wanted to throw out to you a question that we had come in from a number of people, which is basically, how long do you plan for the due diligence process? And maybe just talk through how to think about that piece of it.
Yeah, great question. So if you've taken my advice and you plan for years, you can shorten that a little bit, but nobody actually listens to my advice in real practice here. So as I can see Tracy and Evan in the background saying that's correct. You're usually going to want to plan for an 18 to 24 month roadway to really get to probably the org meeting, meaning leading up to that point in time, you're going to need to take at least that amount of time just to get your house in order, get the right people hired, get all of your documents together, do all of that kind of baseline preparation. While seemingly a long period of time, in terms of really getting your house in order in many cases, it goes by in a flash, and getting that cap table audit done and getting all of those types of things sorted out, it really does take a long time, and it takes a lot of kind of outside resources, including making sure your audited financials are prepared, et cetera. Some companies these days are lucky enough to have started that and are getting more requirements earlier in their life cycle to get at least reviewed financial statements completed. And so that helps with those audit type of processes. But as a general matter, you really want to make sure that on-ramp is 18 to 24 months before you're really starting to engage in a formal org meeting and then going through the IPO process.
Great, thank you. Tracy, I'm going to throw one your direction. As a CFO, how do you weigh IPO workload lift for FP&A on versus accounting teams? And does one get pulled in harder than the other? And what are the top 2 or 3 heavy lift tasks for each of those teams? I know that's a lot.
That is a lot. And it is different for both of them in terms of the timing as well. So if you think about the accounting team, you just heard Albert say it's going to take 18 to 24 months ahead of the IPO to get ready. On the accounting side, they're making sure they have PCAOB compliant audits. They're, breaking down and having their quarters reviewed. They're looking at internal controls, making sure they don't have any material weaknesses, or if they do, how they're going to explain them. On the FP&A side, they're making sure they have reliable forecasting, because the worst thing you can do is come out and miss a quarter. And so you're testing and learning over that 18 to 24 months. You're actually going to create call scripts and do dry runs and create guidance and practice being a public company before you are a public company. And then I would say the lift, there's a significant lift on both sides of those teams, as well as your legal teams, because they're going through a massive risk assessment. And the thing that I found, the reason the 18 to 24 months is so critical is when they do that risk assessment, you realize I'm not collecting sales tax in all the jurisdictions I'm supposed to, or I, potentially am violating the money transfer regulations between states. And so you have to go back and clean all of that up. That's the part that takes, I think, the longest, is to make sure your risk profile is in order before you go public.
But if I can, Ann, just to jump in on
Please
that real
do.
quick. I think really Tracy hits on a really critical point here, which is the risk profile has just expanded substantially over the past few years, because companies have to deal more and more with cyber incident response, A&I oversight, what's going on from that perspective. So there's really just more risks that have to be evaluated by a company. And they have to also get board members in there who have expertise in these areas so they can properly oversee the company. And that's certainly something that companies are struggling with in terms of getting the right board members on board in the right times in advance of an IPO to make sure they're ready for that type of and level of oversight. Because again, and now something I'll switch back to real quick from Evan's point earlier, there are plaintiffs' attorneys that are starting to look at all of these disclosure obligations and nitpick when directors don't have specific expertise, and really diving in and looking at these additional regulations that have been put into place over the past 4 or 5 years, and really finding innovative ways to go after companies using those for mootness fees and other fees as well. So a really critical element. And Tracy, I'm glad you hit on that.
Great. Well, thank you both for that. I'm going to throw one over to Evan now. And this is something that came up in the Q&A that I've often heard about too, which is, what's your suggestion around building out an investor relations capability as you go to becoming public? Because that is a big change for a lot of companies.
Yeah, good question. The route that worked for us, we chose an outsourced IR firm. The reason we did that is we wanted to have access many people. They were a big firm. They had multiple partners. Of course, we had our own kind of main contact and their assistant. But I wanted to be able to tap into like many brains, because you're going to deal with many different issues that you can't expect. So I wanted just more people to choose from. And then either a year and a half in, we brought it in-house. We had a transition period between the IR firm and the in-house person, but then eventually we went in-house. So that's on the post-IPO process. Pre-IPO, I would make a huge plug for, you can hire advisors to the CFO that don't work for the bankers. They work for you, right? The bankers, they have their own objectives and they're not the same as the company. Well, this was when I went through our IPO, it was the first time that I had taken a company public. So we hired an IPO advisor that worked for me and gave me advice on how to run a proper bake-off, how to, which research analysts they liked, how to prepare proper dry runs and test the waters and meetings and so forth. So that's my other plug, is hire a pre-IPO advisor.
Yeah. Tracy, anything you would add on that, having gone through a couple different versions of this?
No, I think that was one piece of advice I remember from our lunch, was like, you were absolutely going to need to hire an IPO consultant because it's going to save you down the road. And so we did, and it was extremely helpful, except that we paused the IPO and then went SPAC merger. So it was completely different. But one of the things that I underestimated is the emotional hostage situation that bankers will do to try and get their placement in the syndicate as well as the fee structure. And then, God forbid, you change something when you do your secondary and the phone calls that you have to do, you know, where they, so for me, like emotionally, I just felt like I was disappointing everyone. Because yeah, the emotional hostage situation is very real. So an IPO consultant can help with that quite a bit.
Yeah, building your syndicate. So we changed lead left from IPO to our follow on. So there's a whole, so exactly what Tracy's talking about happened. So one, it's no fun to set up the fee structure. Everybody's never, it's not a celebratory moment. Everybody's complaining about what they got, you know. And then if you redo it, oh, you're just, I mean, I'm glad we chose a new lead left, but it is not, it is one of the least fun parts of the process.
Well, thank you for that vision of it. It sounds very complicated, but the other question alongside how difficult is it is how expensive is it? So we've had a number of questions of what does it really cost to go through an IPO between your CPAs, auditors, bankers, law firms, et cetera, et cetera. Any insight into that either? Maybe start with you, Tracy. You've kind of gone through this more recently.
Yeah, definitely, because you disclose all of those fees for the most part in your public filings. And so any CFO can go out and look at, you know, what the IPO fees were for a specific transaction. But the other thing is it's not about the transaction fees. To me, that's a one-time cost. It's about the ongoing fees of being a public company. Your outside counsel fees are going to be more expensive. Like Evan said, the D&O is a surprise to everyone, but the increase in your audit fees when you have to be 404B compliant and leading up to that is like a true sticker shock as you work through that process. And then you also need to include the cost of the internal team that you've now staffed up for this as well. So the ongoing cost, you know, depends on your company, but it can be, you know, depending on D&O, like $10 million.
Wow.
Cost. Yeah.
Albert or Evan, either one of you want to throw anything else out in that range of the sticker shock?
We had
Evan,
one
go ahead.
new capability we hired for that was not on the team. So some of these meaningful ongoing new costs, we hired some technical accountants that are specialists in how to make SEC submissions the right way, and they're also technical experts in GAAP and so forth. And so I would say like pre-IPO versus post-IPO staffing, that's a big change. And then definitely Tracy hit on internal legal teams. So you start hiring a more robust team underneath the GC. Those are kind of examples of that wage costs that increase when you go public.
Yeah, and then I agree with both of what you just said. The other thing that also increases, and sometimes is a surprise, when you put new instruments in place, you get a credit agreement, you get warrants, you have something like that. You now introduce potentially valuation experts. They take time during your quarterly closes. They increase the cost just generally of doing those things. So I think some companies ultimately take it a little bit lightly that they're, adding warrants to a deal at the last minute, and that can really have an impact on, ongoing costs and operating expenses that are sometimes a surprise.
Well, I'm disappointed to say that we're actually a little past the top of the hour. It has been such an amazing conversation. Thank you all for joining us. I can't thank my panelists enough. Please feel free to reach out to any of us with our addresses. I believe we have that on the presentation, and we really look forward to seeing you on our next one. Thank you so much.